On September 7th, the Bank of Canada announced a 0.75% interest rate increase, which has caused a large number of Canadians with variable rate mortgages to hit their trigger rates. An even larger number are on the brink of it, and the Bank of Canada has alluded to more rate increases in the future. So what is a trigger rate? A trigger rate is a tool built into an adjustable rate mortgage at which point the amount of money paid per mortgage period must increase. Approximately 80% of variable rate mortgages in Canada fit into the adjustable rate mortgage category containing a trigger rate. This happens because the amount of money paid each month becomes lower than the interest being paid. For example, let's say your monthly mortgage payment is $100 for simplicity's sake, although that would be a wonderful mortgage payment to have. When you first start out, you may be paying $40 towards your principal and $60 in interest. After one rate hike, it may become $25 towards your principal and $75 towards interest. After the second rate hike, it may become $10 towards your principal and $90 towards interest. With the third rate hike, now it's $0 towards the principal and you owe $105 in interest, but you're only paying $100. This is why it is called a trigger rate. You've hit the point where there is more interest than your payment, and naturally banks won't stand for this and will force your payments to rise. How do you know what your trigger rate is? The calculation is pretty simple. Take your mortgage payment amount, multiply it by the number of payments you make in a year, and divide all of that by the amount of money you owe on your mortgage principal today. Then simply multiply that by 100 and you have your trigger rate amount. For example, a $2,000 monthly payment and a mortgage balance today of $500,000 means you are taking $2,000 multiplied by 12 all divided by 500,000, which will give you 0.0480 times that by 100 will give you 4.8%. If this is a lifesaver for you, hit the like button. What this means in the simplest terms is that your payment will jump from whatever interest rate you were locked in at the current prime, plus or minus X percentage, that was in your initial contract. The prime rate is the commercial lending rate by banks to customers with top-tier credit scores. In Canada, this functionally means people with a credit score over 720. With the 0.75% hike from the Bank of Canada, that has moved the prime rate from 4.7% to 5.45%. If your score was over 720 at the time of getting your mortgage, you are more than likely prime minus X percent, but it's important to check your documents carefully and double check with a mortgage calculator so you know you're being charged the right amount. The secondary problem with adjustable rate mortgages that contain a trigger rate is that it is very likely your amortization period has been dramatically climbing over the last year as rates have risen. From the example earlier, we can see that the amount you're paying towards your principal each payment is going down with each rate hike, and therefore the overall length of your mortgage has been climbing. It is very likely that your 25-year mortgage is now a 46-year mortgage, or in more extreme examples, it could be a 75-year mortgage. This is something that is also very important to consider, to analyze, and to approach thoughtfully, because when your current mortgage expires at the end of your 5-year term, the next mortgage provider, whether it is your current or you switch, will expect you to get back on a 25-year or 30-year timeline, and therefore your payments will jump dramatically at the time. Fortunately, most of the people hitting the trigger rate are people who started with incredibly low interest rates from the last 2 years, and therefore should have at least 2.5 to 3 years left to make the necessary financial plans to protect themselves. What does this all realistically mean if you hit your trigger rate or think you will hit your trigger rate in the next interest rate hike? You need to read your mortgage documents very carefully for all the options available to you, because every bank and mortgage lender has different policies and different options. The most important thing to note, though, is that you do not have to requalify for your mortgage at the higher rate as long as you keep making your payments. Your provider will be happy with you until the renewal time comes. Some possible strategies to combat rate hike, however, include making a lump sum payment, increasing your monthly payments, or voluntarily extending your amortization. The fourth possible situation is something done by TD Bank and a few others, where they will not adjust your rate or require you to adjust your rate. Instead, they will start adding the interest amount that you are not paying onto your principal, which is incredibly punishing and why you must read your documents very carefully. A lump sum payment is pretty straightforward. If you pay off $20,000, suddenly the amount of interest you will be paying on a monthly basis goes down as well. The more you can throw at this problem and still make payments, the better for you in the long run. If you have cash invested in a TFSA, this may be the time to utilize it to give yourself a shorter amortization and a lower monthly payment. Increasing your monthly payment is very simple, and the only question you need to ask is how much can you afford. The more you raise your payments, the more of your principal is being paid down with each payment, but the minimum required would be to simply get your payment above your total required interest per payment. If you extend your amortization period, it will drop your overall monthly payment, which will affect the top part of the trigger rate calculation, and therefore your trigger rate percentage will increase, staving off the sudden shock. For even more information on trigger rates, click on the video right here and subscribe for more.